deferred payment are a series of payments, the right to use an asset for an agreed period of time. The objective of IFRS 16 is to specify the principles for recognition, measurement, presentation, and disclosure of leases. IFRS 16 does not apply to leases to explore for or use of mineral, oil, and natural gas. Second, leases of biological assets or IAS 41. Intellectual property licenses or IFRS 16. Service concession arrangements or IFRIC 12. And rights under licensing agreement or IAS 28. To classify the lease, you have to ask this question. Are rewards and risks transferred to lessee? If yes, it is a finance lease. If no, it is an operating lease. There are 5 criteria for a lease to be classified as a finance lease. First, the lease transfers ownership to the lessee by the end of the lease term. Second, the lessee has the option to purchase the asset at a price less than its fair value. Third, lease term is a major part of the economic life of the asset, even the title is not transferred. Fourth, at the inception of the lease, the present value of the lease payments amounts to at least substantially all of the fair value of the leased asset. Fifth, leased asset has specified nature that only the lessee can use without major modifications. Under the lessee, at the commencement, shall recognize both asset and liability equal to what is lower between fair value and present value or minimum lease payments. Present value shall be calculated using interest rate implicit in the lease. If this cannot be determined, use incremental borrowing rate of the lessee. Any direct costs incurred by lessee in the negotiating and arrangement of lease are added to the cost of the asset. Lessee shall recognize depreciation over the useful life of the leased asset. However, if the asset is not pre-owned, divide its depreciation between the useful life and lease term whichever is shorter. Minimum lease payments. And lastly, charge contingent rent as expense in the period incurred. Under the lessor, there are 2, the direct financing lease and the sales type lease. Direct financing lease recognizes interest income, while in the sales type lease, it recognizes both the interest income and gross profit on sale.
Operating lease. A lease should be classified as operating lease if it does not transfer substantially all the risks and rewards incidental to ownership. Under the new lease standard, all lease should be classified as finance lease. But under the new lease, under SMEs, lease should be classified as either operating lease or finance lease based on the transfer of risk and rewards. But also under the new lease, entities are permitted to use the operating lease accounting under 2 exemptions. Number 1, low value lease, and number 2, short-term lease. Low value lease. A lease should be low value based on the professional judgment of the management, the accountant, or even financial managers. Short-term lease. A lease should be classified as short-term if its lease term is 12 months or less. Operating lease, lessee. Number 1, the lessee shall recognize rental payments as rent expense. Number 2, the cost of services incurred in the leasing process shall be expensed outright. Operating lease, lessor. Number 1, the lessor shall recognize rent income. Number 2, the lessor shall present assets subject to operating lease according to their nature. Number 3, the lessor shall recognize expenses incurred in earning the rent income. And number 4, any initial direct cost shall be deferred and amortized over the lease term. Sale and leaseback. Sale and leaseback involves 2 kinds of transaction. The first one, the sale of an asset. And number 2, the leasing back of the same asset. It also involves 2 persons, the seller lessee and the purchaser lessor. Sale and leaseback occurs because the seller lessee experience cash flow or financial problems in which he or she does not want to recognize expenses incidental in owning the asset. Leaseback under finance lease. If you are studying about leaseback about finance lease, you have 2 things to remember. Number 1, any excess of the sales proceeds over the carrying amount of the asset is deferred and amortized over its lease term. So the second one, any gain or loss on the sale is recognized immediately. Leaseback under operating lease. If you are studying about the leaseback under operating lease, you have 3 things to remember. Number 1, the transactions are established at fair value. Number 2, the seller lessee shall recognize gain or sale immediately. Number 3, if the sales price exceeds the fair value, any gain or loss shall be deferred and amortized over the asset's life. Comparison of the full PFRS and the PFRS for SMEs. Under the lessor accounting, it is practically the same. Under the lessee accounting, it has two differences. Number 1, under full PFRS or the PFRS 16, under the new lease standard, all leases shall be classified as finance lease. But under the PFRS for SMEs, lease should be classified as either operating lease or finance lease. But the new standard permitted entities to use operating lease under two exemptions, whether it is low-value lease or short-term lease. What is the difference between finance lease and operating lease? Under finance lease, you should recognize lease liability and the right to use an asset. Under operating lease, if you are the lessee, you should recognize rent expense. And on the side of the lessor, you should recognize rent income.
So let's have some problem example for the operating lease. On December 1, 2017, Tel Company leased office space for 5 years at a monthly rental of 600 pesos. On the same day, Tel Company paid the lessor for the following amounts. Bonus to obtain lease, 300,000. First month's rent, 600,000. Last month rent, 600,000. Security deposit, refundable at lease expiration, 800,000. Installation of new walls and offices, 3,600,000. So the question is, what total amount of the expenses relating to utilization of the offices space should be reported for 2017? For the computations, the bonus to obtain lease of 300,000 should be amortized. Simply means 300,000 over 5 years equals to 60,000 times 1 divided by 12 is equals to 5,000 pesos. Rent for the December, 600,000. Depreciation of leasehold improvement, 3,600,000 divided by 5 times 1 over 12 is equals to 60,000. The total expense for 2017 is equals to 5,000 plus 600,000 plus 60,000 is equals to 665,000 pesos. Let's talk about the employee benefits. Employee benefits is the consideration given by the entity in exchange for service rendered by employees, directors, and management, or for the termination of employment. The benefits includes short-term employee benefits, post-employment benefits, other long-term employee benefit, termination benefit, and share-based payments. Short-term employee benefits, these are employee benefits other than termination benefits that are expected to settle fully within 12 months after the end of the period which employee renders service. Short-term employee benefits includes salaries, wages, and social security contribution. The example of social security contribution are SSS, PhilHealth, etc. Short-term paid absences as paid annual leave and paid sick leave. Short-term paid absences is where entity may pay employees for absences for various reasons. There are two entitlements to paid absences: the accumulating paid absences and non-accumulating paid absences. Accumulating paid absences are those that are carried forward and can be used in future periods if the current period's entitlement is not used in full. Halimbawa, kung binigyan ka ng kumpanya ng 20 days leave at sa buong taon ay nagkaroon ka lamang ng 10 days leave, ang 10 days na natitira sa iyo ay mapupunta sa susunod na taon. Ibig sabihin, sa susunod na taon ay mayroon ka ng 30 days leave. Next is the non-accumulating paid absences are those that are not carried forward. Ibig sabihin, kung ang 10 araw na natitira mong leave, ito ay hindi na maaari maidagdag pa sa susunod na taon. Ibig sabihin, ang susunod na taon ay mayroon ka lamang 20 days leave. Next is we have the profit sharing and bonuses payable within 12 months. And non-monetary benefits, example are medical care, car and free or subsidized foods.
Post-employment benefit are employee benefit which are payable after completion of employment. There are two types of post-employment benefit plan. First is the defined contribution plan in which the entity pays fixed contribution into separate entity known as the fund. The employer makes contribution each year based on the formula defined by the plan. Therefore, the employer's annual pension expense is equal to the employer's contribution to the plan. So, the benefit is proportion to the contribution. The next one is the defined benefit plan. In defined benefit plan, the entity's obligation is to provide the agreed benefit to the employees. Unlike in defined contribution plan, the employee may agree to such amount of benefit, but usually it depends on the average wages and salary every year. In defined contribution plan, the contribution is definite, but the benefit is indefinite, because the entity will have no legal or constructive obligation if the fund does not hold sufficient asset to pay all employee benefits relating to the employee service in current and prior period. While in the defined benefit plan, the benefit is definite, but the contribution is indefinite. Actually, in this case, the entity must make contribution such that the contribution plus earning would be sufficiently large to cover future retirement benefits. Examples of post-employment benefit plan under the law is Social Security System. This post-employment benefit plan is a defined contribution plan because the entity's obligation is limited to specified contribution to the plan as percentage of salary. The next example is the Republic Act 7641, also known as the Philippine Retirement Pay Law. This post-employment benefit plan is a defined benefit plan because the entity's obligation is to provide specific amount of benefit for every year of service. Let's proceed in the measurement of defined contribution plan. An SME shall recognize the contribution payable for a period. First, as a liability after deducting any amount already paid. If the contribution payment exceed the contribution due, at the reporting date, the entity shall recognize that excess as an asset. Next, the contribution shall recognize as an expense unless another provision from PFRS for SME that contribution is to be recognized as part of the cost of an asset such as inventory or PPE. Let's proceed in the measurement of defined benefit plan. An SME shall measure a defined benefit plan liability as the net amount of the following. First, determine the present value of the defined benefit plan obligation at the reporting date. Next is minus the fair value of the plan asset at the reporting date. The plan asset represent the fund out of which the defined benefit obligation are to be paid directly. Meaning, if the entity pay insurance premium to fund a post-employment fund, they can deduct it on their liability.
Let's now proceed to the actuarial gains and losses. An SME is required to recognize all actuarial gains and losses in the period which they occur. However, the SME has an accounting consequence of recognizing all actuarial gains and losses, either A, in profit or loss, B, in other comprehensive income, other long-term employee benefits. Other long-term employee benefits are all the employee benefits other than post-employment benefits, short-term employee benefits, and termination benefits. Examples of other long-term employee benefits are A, long-term paid absences such as long service or sabbatical leave. B, jubilee or other long-service benefit. C, long-term disability benefit. D, profit sharing and bonuses. And last one, E, deferred compensation. Recognition and measurement of other long-term employee benefits. The amount recognized as a liability for other long-term employee benefits shall be the net total of the following amounts. A, present value of the defined benefit obligation at the end of reporting period. And B, minus the fair value at the end of reporting period of the plan assets. The plan assets represent the fund out of which the other long-term employee benefits are to be paid directly. Termination benefits. Termination benefits are payments made by an entity to employees when it terminates their employment as required A, by legislation, contractual, or other agreement with employees or their representatives, and B, by constructive obligation based on business practice, custom, or a desired to act equitably. The entity shall recognize termination benefits as expense and liability when the entity is demonstrably committed to either A. Terminate the employment of an employee or group of employees before the normal retirement date, and B. Provide termination benefits as a result of an offer made in order to encourage voluntary redundancy. Measurement of termination benefits. The termination benefits shall be measured at the best estimate of the expenditure that would be required to settle the obligation at the end of the reporting period. A. Termination benefits fall due more than 12 months after the end of the reporting period are discounted using the applicable discount rate. B. In the case of an offer made to encourage voluntary redundancy, the measurement of termination benefits shall be based on the number of employees expected to accept the offer. Let's now proceed to the comparison with full PFRS or past 19R. Full PFRS and PFRS for SMEs share the same principles for the recognition and measurement of the following: A. Short-term employee benefits. B. Defined contribution plans. C. Other long-term employee benefits. And D. Termination benefits. Full PFRS and PFRS for SMEs also share many of the principles for the recognition and measurement of defined benefit plans. Number 1. Under both full PFRS and PFRS for SMEs, all past service costs are now recognized as expense immediately regardless of vesting. Number 2. Under full PFRS, all remeasurements of defined benefit plan, including actuarial gain or loss, are recognized through other comprehensive income. However, amounts recognized in other comprehensive income are not subsequently recycled to profit or loss, but may be transferred within equity or retained earnings. Under PFRS for SMEs, actuarial gain and loss are A. Recognized immediately in profit or loss, and B. Recognized immediately in other comprehensive income. The SME has an accounting policy choice if the SME elected to recognize such actuarial gain and loss in other comprehensive income. The amount is not subsequently recycled to profit or loss, but transferred to liquid earnings. Number 3. Under full PFRS, the projected unit credit method must be used in measuring the defined benefit liability. Under PFRS for SMEs, the projected unit credit method is used in measuring the defined benefit liability if the information that is needed to make such as calculation is already available or can be obtained without undue cost or effort. If this is not the case, an alternative method is permitted in which future salary, future service, and possible mortality between reporting date and the date of employees are expected to begin receiving post-employment benefits are not considered. Number 4. Under both PFRS for SMEs and full PFRS, the defined benefit liability is the net total of the following amount: A. Present value of benefit obligation at year-end, and B. Minus the fair value of the planned assets at year-end. Number 5. Under both PFRS for SMEs and full PFRS, there is no more concept of expected return. Under PFRS for SMEs, all changes in the fair value of planned assets are recognized in profit or loss. Under full PFRS, the interest income on the fair value of planned assets at the beginning of the period is included in profit or loss as component of employee benefit expense. The difference between the actual return on planned assets and the interest income is recognized as a measurement through other comprehensive